In many cases, what can happen is, and particularly in case of various multinational corporations, there are special relationships which may exist between the payer of royalty and the recipient of royalty, or FTS for that matter, right? In some cases, they may pay to their related enterprise more than what is liable to be paid, or actually what should be paid to an independent third party, right? And these are tools which various multinationals use to extract money out of the source country. So let's say, for example, I'll tell you how this works is that suppose there's a foreign company, right? And you have an Indian company here. When the Indian company makes a payment of royalty or FTS, they get a deduction of 30% plus surcharge, etc., against their taxable profit. So they've saved 30% on taxes when they make a payment to the foreign company. This foreign company would typically be liable to pay either 10% or 15% by way of withholding tax in India, right? In many cases, what you will see is that these foreign companies are structured in jurisdictions where their total liability on such royalty or FIS will not be more than 10 to 15%, which means after claiming a credit of this 10-15%, the tax that they pay is 0%. Now look at the beauty of this, that you've saved taxes to the extent of 30% here, right? As against which you've paid only 10 or 15% in the source country, right? As against this, if you would have not claimed this, you would have paid 30% taxes on your profits. And then whatever money was remaining, even if you would have paid it to your shareholder or the related enterprise, you would have further paid a dividend distribution tax on that. So the savings are twofold. You save dividend distribution tax and you also save kind of this 30% tax here, minus whatever withholding tax is applied in these cases. Now, so what does it mean? So let's say, for example, if there's a foreign company which has a 100% subsidiary in India, right? If this subsidiary makes a payment to the foreign company in excess of what it should make for royalty and FTS, right? Or let's say this foreign company has a foreign subsidiary, or the Indian subsidiary makes a payment of royalty or FTS to the foreign sub, right? If there's an excess royalty or FIS which is paid by I sub, which is this company, to FCO or F sub, how would the taxation work? So let's say the arm's length price is $100, there's a payment of $150. This is something which is dealt with in Article 12, paragraph 8. Let's see that. Where by reason of special relationship between the payer and the beneficial owner. This is between the I sub and the foreign company, or between both of them and some other person. This is the F sub that we are referring. F sub is in a relation with the two of them together. Why? Because FCO is effectively the parent of this company and FCO is the parent of this company. So the FCO can very well insist to I sub that they should make a payment which is more than arm's length to F sub. So where by reason of this kind of a relationship, the amount of royalties or FIS paid exceeds the amount which would have been paid in the absence of such relationship. So let's say we paid $150 in the example, exceeds the amount which would have been paid in the absence of such relationship. In the absence of such relationship, we would have paid $100 because that's the arm's length price. The provision of this article shall apply only to the last mentioned amount. Now what this means is that only $100 is going to be taxable under Article 12. In such a case, the excess part, which is $50 of the payment, shall remain taxable according to the laws of each contracting state, which means India has a right to tax this payment according to its own laws, due regard being had to the other provision of the convention. Which means that when you are making this payment, you have to have a regard to other provision of the convention. Which means if India treats this as other income and taxes it and says I have a right to tax this income, but the other income clause under the treaty says that the right to tax this income is with US or whichever country that is, then the provision of treaty will prevail and India will not be able to tax that under the domestic laws.